Welcome to Illuminati Silver. We tell you the truth about silver. Today is Tuesday the 9th of February 2016 and we're addressing the issue of gold and silver price manipulation. In parts 1 to 3 we highlighted the main advocates who've accused governments and central banks of such manipulation. In videos 4 and 5 we highlighted some of the main forms of alleged manipulation, including naked shorting and manipulation of the London fixes. And today we're briefly covering OTC or over-the-counter derivatives and high-frequency trading. Now, before we discuss how OTC derivatives are allegedly used to suppress the price of gold and silver, we should firstly define what an OTC derivative is. Quote, over-the-counter derivatives are contracts that are traded and privately negotiated directly between two parties without going through an exchange or other intermediary. Products such as swaps, forward rate agreements, exotic options, and other exotic derivatives are almost always traded in this way. Unquote. So, OTC derivatives are privately structured contracts created essentially by large banks. They are a paper or derivative form of an underlying financial instrument or commodity. Little is known about them outside of those who operate such systems, and the CFTC do not regulate them. The absence of regulation means that information is not available that would indicate the purposes for which the banks use these derivatives. According to Dr. Paul Craig Roberts, when JP Morgan was investigated for its short silver position on COMEX, the bank convinced the CFTC that its short position on COMEX was a hedge against a long position via OTC derivatives. In other words, JP Morgan used its OTC derivatives to shield its attack on the silver price in the futures market. In an article written on his website on the 8th of July 2015, he states, quote, during 2015, the attack on bullion prices has intensified, driving the prices lower than they have been for years. During the first quarter of this year, there was a huge upward spike in the quantity of precious metal derivatives. If these were long positions hedging the bank's COMEX shorts, why did the price of gold and silver decline? Unquote. He goes on to add, quote, the circumstantial evidence is that the unregulated OTC derivatives in gold and silver are not really hedges to short positions in COMEX, but are themselves structured as an additional attack on precious metal prices. If this supposition is correct, it indicates that 7 years of bailing out the big banks that control the Federal Reserve and US Treasury at the expense of the US economy has threatened the US dollar to the extent that the dollar must be protected at all costs, including US regulatory tolerance of illegal activity to suppress gold and silver prices. Unquote. Another alleged form of manipulation is that called the HFT, or high-frequency trading wash. High-frequency trading, or HFT, is a program trading platform that uses powerful computers to transact a large number of orders at very fast speeds. It uses complex algorithms to analyze multiple markets and execute orders based on market conditions. Typically, the traders with the fastest execution speeds will be more profitable than traders with slower execution speeds. US regulators have, over the past few years, carried out a number of investigations to look into whether high-frequency traders are routinely distorting stock and futures markets by illegally acting as buyer and seller in the same transactions. Such transactions, known as wash trades, are banned by US law because they can feed false information into the market and be used to manipulate prices. Intentionally taking both sides of a trade can minimize financial risk for the trading firm while potentially creating a false impression of higher volume in the market. The Commodity Futures Trading Commission is focused on suspected wash trades by high-speed firms in futures contracts tied to the value of crude oil, precious metals, agricultural commodities, and the S&P's 500 stock index, among other underlying instruments. The accusations here have been that such trades, increasing perceived volume, have successfully manipulated the gold and silver market by creating false impressions about trade levels, especially when in a downward trajectory. So in summary, it is generally alleged that gold and silver prices are forced artificially low to create the illusion that metals have little value, and the volatility scares off new buyers. The US government and its allies on Wall Street play this dangerous game to engineer artificial confidence in the dollar. Bullion banks are government's complicit brokers and do this by selling their mix of real physical and pretend paper gold and silver through contracted futures, options, and exchange-traded funds. With manipulations of the London Fix, OTC derivatives, and HFT washes, these bodies have a number of sophisticated systems to ensure that gold and silver prices are held down for as long as is humanly possible. Our next two videos will highlight some of those who believe that manipulation does not occur in the bullion market and their arguments for stating this. We hope you have found this video interesting and informative, and if so, please give it a thumb up and share it on Twitter. Also, kindly visit our website at www.illuminatisilver.com and look at our Facebook page, which is updated daily at www.facebook.com/illuminatisilver. Disclaimer: Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.